Good evening everyone, and welcome back to another video on how to trade the London session and how to read the price action effectively and how to make a well-informed trading decisions. Today we will be analyzing gold on March 7th, as you can see it here, 2025, during the London session, breaking down why I was expected higher prices and how you can apply this knowledge to enhance and increase your understanding of the markets. So let's start by looking at the 15-minute time frame, as you can see it here. And I was anticipating higher prices on gold to target the buy side, and the price played exactly as expected. But let's go deeper. Why did I expect the price to move higher in the first place? Because understanding this will help you develop the right trading mindset and improve your ability to predict the market movements. So, at the beginning of the trading day, which is between 4:59 and 6 p.m., we saw the price drop into this fair value gap and taking this sell side liquidity. And then the price started pushing higher, which was my first sign of bullish momentum. Another key observation on the 15-minute time frame is how the indicator began to show an upward momentum and how price respects this movement by tabbing here and rejected. This reinforced my bullish bias. When you see the price keep taking the buy side without a major pullbacks, then this is a sign for you that the price is in a bullish momentum, or in a bullish system, you can call it. Then looking for a selling opportunities would be the worst scenario to start to sell, and this is why I was expecting higher prices. Then as the London session opened, price took out this buy side liquidity and showed no signs of weakness to go to the lower prices, or even indicates a lower prices, and even we can see the indicator here. Then the only thing I was looking for is for the higher prices or the upside momentum. At this point I decided to look for entries targeting higher prices, specifically aiming for the buy side liquidities levels above, which is this one and this one and this one. Now let's drop to the 1 minute time frame and go through the prices and the confirmations I was looking for and how you can apply this approach to your own trading journey. Now that we are on the 1 minute time frame, let's analyze what happened at the start of the London session between 150 and 210, which is from here and here. The prices dropped at this old 15-minute fair value gap at exactly 150 just before the London Open, which is at 2 a.m. Since we had already determined our bullish bias, we were expecting prices to move higher, targeting the buy side liquidities, as you can see it here. The prices dropped after the beginning of the London session. The prices dropped into a discount area where you can see it here. So at the beginning of the London session, the prices did trade it to here, and then as we know, there is a discount and a premium area. In this move, the prices did drop into this discount area, which is the fair value gap. And then after that, after tapping to this 1 minute fair value gap, the prices start to move to the higher prices with respects to the indicator that shows also a bullish momentum to the higher prices. And this is why you need to wait for the prices to go to the discount area before you buy, or to the premium area before you sell, which is the discount area is under 50 level in the Fibonacci, which is this one, and the premium area, which is above the 50 level in the Fibonacci tool. And this is how you determine the premium and the discount areas. In the beginning of your trading journey, one of the biggest challenges that you will face is deciding on the correct bias for the session. Many traders mistakenly believe that they need to predict the bias for the entire day, but this is not necessarily correct, especially for the new traders. Now, I'm sure that most of you already know how to determine the daily bias, and that 80% of the time you get it right. But the real problem is that you don't fully understand the dynamics of the price action. This lack of understanding leads to inconsistent results because many traders don't recognize that the importance of the discount areas and the premium areas when looking for entries. For example, if you want to buy, as I mentioned before, you need to wait for the price to drop into a discount area, which is the red one. And if you want to sell, if your bias for that specific session to target the lower prices, you need the price to go to the premium area, then entering, for example, a fair value gap or an order block or something like that, then you can sell. And failing to recognize this principle, I guess it is one of the most reasons why traders struggle, especially when they use the ICT concepts. Because most traders enter at the wrong locations, hoping price will go straight to their targets. I'm sure all of you have been in this situation where you go long or short only to see the price move against you before eventually going to your direction. And I'm not talking about being off by 3 pips or less. I mean completely missing the right entry zone. So let me show you an example using the fair value gap on this chart. I guess many traders, after identifying the bullish bias, would enter at this fair value gap, which is this one. Okay. Thinking that the price will immediately move higher. However, this is a big mistake. Because, for example, let's say you entered here. When you use the Fibonacci tool, you will see that the price is already in a discount area. This is correct. But you have to analyze and see this order block and know that the prices may go to this order block. And this is why sometimes it can wick some areas here and then completely go to the higher prices. Or I see some people who enter on this fair value gap expecting the prices, after tapping into this fair value gap, start to go to the higher prices. But as I mentioned before, that you have to put the Fibonacci levels to know exactly where is the premium areas and the discount areas. And as I said before, if you want to buy, you have to wait for the price to go to the discount area, and if you want to sell, wait for the price to go to the premium areas. And this is the number one reason why people find struggles to be profitable in using the ICT concepts, because they don't fully understand how to apply these concepts into the day-to-day trading. So that's it for today, and if you have any questions, leave them in the comments. Thanks for watching, and see you in the next video.